a 14% premium. Shanghai is paying $85 for silver. COMEX is at $75. That gap is live right now. OG John AG here. Drop OG John AG in the comments if you are here paying attention and actually learning. Now, silver moves into first notice day in 3 business days. Let's get straight into it. Silver trades $75.11 to $75.84 in New York. Shanghai fixes at Y18,705 per kilogram morning. That equals roughly 85.10 per ounce. Afternoon fix rises to Y18,020 per kilogram. That widens the premium to 14.0%. That is a double-digit divergence. That is sustained. That is not noise. Before we go further, if this kind of data-first analysis is what you have been looking for, hit the like button right now. Subscribe to OG John AG 1.0 and share this with one person who needs to see these numbers. Now, back to the data. Lead story today: COMEX silver inventory and May delivery structure. Registered silver stands at 77.1 million ounces. Coverage ratio sits at 13.9%. Paper leverage reads 7.2x. May open interest shows 26,963 contracts. That equals 134.8 million ounces. Effective first notice day arrives in 3 business days. This follows persistent drawdowns in registered stocks since early 2025. The unusual detail is the timing. The timing. Open interest remains elevated into delivery. The timing is what deserves scrutiny, not the inventory alone. The timing. Think about what that sequence actually means. A coverage ratio below 15% signals stress historically. Open interest exceeding registered stocks signals pressure. What happens if a fraction stands for delivery? The ones paying attention already know what to watch next. Before I show you the full data picture, consider this. The last time coverage ratios approached these levels, delivery stress increased sharply. The data is already telling you something. Let's build it out. Now let's build the full picture because COMEX inventory does not exist in a vacuum. CME Group warehouse reports have dropped. 77.1 million ounces registered out of total inventory reported by CME. 26,963 contracts still open into May per CME data. Shanghai Gold Exchange fixes confirm Y18,705 and Y18,120 per kilogram. That is a $10 spread versus COMEX spot. The Silver Institute projects a 67 million ounce deficit for 2026. China import data shows highest silver imports in 8 years. That is year-over-year acceleration. COMEX delivery rates remain below 1% historically. Shanghai requires physical delivery. That is the second dataset connecting the divergence. The third dataset is leverage. 7.2x paper claims per ounce of registered metal. The rate of divergence is not slowing. It is compounding. The data is doing the talking. The ones who have been called alarmist for pointing at physical shortages, they are not saying much right now. And here is what makes that picture even harder to ignore. A 13.9% coverage ratio implies limited delivery buffer. A 7.2x leverage ratio implies multiple claims per ounce. At the same time, eligible stocks exist as a theoretical buffer. That is not a contradiction. That is the setup. Eligible silver cannot be forced into delivery. Owners must reclassify voluntarily. During stress, that reclassification slows historically. And before anyone takes that as a green light, timing remains uncertain. Setups can take a long time to resolve. What this tells you is the structural picture. The timing is a completely separate question. Anyone who claims to know the timing is selling something. Here is the number most people are not talking about. $10 per ounce. That is the live arbitrage between Shanghai and COMEX. Now geopolitics, because this is no longer a backdrop. It is the primary variable. U.S.-Iran negotiations remain stalled. Hormuz risk remains active. The strait handles roughly 21 million barrels per day. That is a fixed number. That is a cost input into global pricing. At the same time, Federal Reserve expectations shift toward gradual rate cuts. The US dollar index sits at 98.34. That slightly supports metals demand. China's quota system restricts silver imports. A 13% VAT applies on withdrawals. Currency controls limit arbitrage flows. That creates a trapped premium. Markets are still pricing smooth convergence between East and West. Look at a persistent 13 to 14% premium and assign probability to that assumption. When markets start pricing the reality of constrained arbitrage, silver reprices higher. Dollar sensitivity becomes secondary. Physical demand becomes primary. That is the historical pattern. Every time physical demand disconnects from paper pricing, convergence follows. It has not been different yet. Silver Western spot at $75. Shanghai physical equivalent at $85. That is a $10 premium. Short-term picture shows elevated volatility. First notice day is the key event. If May contracts roll to July, pressure reduces. If a portion stands for delivery, pressure increases. That is the only short-term read that matters right now. As for trading it, I cannot see a clean picture on the lower time frames right now. I cannot tell you what silver does tomorrow. Nobody can. If you think you know, good for you. Current environment shows gap risk and thin liquidity. Sidelines is not weakness in this environment. It is the only edge there is. I have called this market both directions. I will call it again when I see it clearly. Right now, I do not see it clearly. The tape decides, not me. Here is the honest truth. Both sides of this trade have a real case, and the one you ignore is the one that will cost you. So let's run both. The bear case is real. Most futures contracts historically roll before delivery. A hawkish Federal Reserve delays rate cuts and pressures metals. A smooth roll reduces immediate inventory stress. The bull case is equally real. Shanghai premium holds above 13% for multiple sessions. COMEX coverage ratio sits below 15% into delivery window. Open interest exceeds registered inventory by 57.7 million ounces. Size correctly. Know what you are in before you are in it. The physical market already knows where this is going. The paper market is still arguing. That argument does not last forever. Everything shown today points to one conclusion. The structural pressure is already built. The only question is timing of release. Don't take my word for it. Verify every number I gave you today. Check the data yourself. CME Group, Shanghai Gold Exchange, the Silver Institute. Logic over hype. Always. If this analysis added value, like this video right now. Subscribe to OG John AG 1.0 so you never miss a data drop. Share this with one person who needs to see these numbers. The ones running the OG John AG 1.0 playbook do not wait for the mainstream to catch up. They already know. The ones who verify do not argue about it. The ones paying attention are watching First Notice Day closely. Sit with that. OG John AG 1.0. Out.